Today is Saturday, August 2nd, 2025. The market is closed. I'm doing my lengthier tutorial on stock options. What are stock options? They are insurance for stocks, how to make money for it, what are their terminology, who's the buyer, who's the sellers, what are calls, what are puts, what are premiums. Let's get to it. So this is my paper money account, which is fake money. If you sign up for Thinkswim, which is the robust trading platform under Charles Schwab, you can get $200,000 of fake money to play with on the platform. So what is options and how do you make money? Now, going back, you'll need a ticker symbol. I'm going to choose a standard ticker symbol, QQQ, NASDAQ 100. You can outright buy and sell stocks. Right here, you can look at the option chain, and that is where you do options. Now, the first thing you'll notice is that the first thing that pops up is the expiration dates. What sets apart options different from stocks is that options has a time value, a time expiration date, a start date and an end date. I'm gonna open up, expand August 4th, which is Monday coming up, August 4th, and see what's going on. Down the middle, it's in ascending order. It gets bigger as you go down. The one in the middle is the strike prices. And I'm going to go to at the money. At the money is this dotted line. This dotted line is the actual price of the stock of QQQ. All right, so what are all of these numbers? Okay, now people want to make money in the context of trading stocks and especially in the context of trading options. Let's say Adam Smith wants to make money. I'm going to frame this in the terms of a buyer. Okay, so Adam wants to make money buying options. So he is going to look at this one right here. Okay, the strike 555 at $2.47. So what happened is that Adam is going to spend $2.47 times 100, which is 247 cents to buy one contract of the strike 555 due by the end of August 4th, 2025. Adam hopes that the price of QQQ is going to go above 555. From that point on, he will get the difference. If it goes to 556 or 557, he will get the difference minus for what he paid for. Okay. It's a little bit easier if you look at the extremes. Okay, this will be, I'll give an example here. So here is 5 cents, and Adam Smith wants to buy one contract, which is 5 cents times 100. That is $5. That's very, very cheap. And at the 567 price, by the end of the day, if the price of the strike goes to 568, 569, Adam only spending $5 would get the spread of the $2 here, which is $200. 566 minus 568. That's an absolute value of 2 times 100. He only spent $5. That's $195. Okay, so that's an extreme. And on the flip side, well, why would anybody spend a higher amount? If this is the cheap way, then why would anybody spend a higher amount? And before you know that, these numbers here are values. Okay, all of these numbers are everything is assigned a certain value. Okay, so this at the money line, it's very volatile. It can go either way. It can go 533, 554, but if you go further and further out, there's less value because it's not likely that it's going to be breached. It's getting harder and harder, likelier that it's going to go in one day all the way to 566 or 567 just in one day. Okay, so it has less value, the buyer will want to pay less for it, and then the seller can only provide so much and provide less as the price of the stock. On the flip side, why would a person pay more, and why would the seller pay more for that too? Out here, it's called the time value price. Sometimes it's called the extrinsic value. This is like the time that's left over, the actual time ticking away to erode to zero, to 3 p.m. Central Standard Time for the stock market. This will all become zero if it doesn't hit it, okay? Now up here, these numbers have more value because added in is the difference between the at the money price and the strike price. So this is 554 minus 552. That's a $2 difference. So if you put it here, it's 443, but it's actually 233. You have to take away the what's called the intrinsic value of the equity, the true value of the price. Okay, so down here, these are called extrinsic, and these are called the intrinsic value. It's the time value with the equity, the true ownership of the strike price. So you're going to have to know intrinsic, which is inside, and extrinsic, which is the time value. Imagine the time value is the raw, real leftover money in priced in terms of time, because again, options is priced in terms of time, whereas a stock is priced just in terms of when you bought it and when you're going to sell it. It could be forever. And that there's also an intrinsic. An intrinsic is this value of the strike minus the at the money price. That you get to keep if it doesn't go above, but you get to keep that price. All right. So, and that would depend on the trader's various strategy. So something that we personally kind of try to do is always be about 1 point away from at the money price. Now on the seller side, we're over here, we're the bid. Okay. Anything that the buyer is gonna get, we're gonna try to match them halfway or match them as close as we can and sell them a price that we see fit. So if they feel like they want to buy a call out the money at 558, we're gonna try to sell them something at 110. And hopefully they'll buy it at that price, or maybe usually they'll buy it at maybe 112 or 111, somewhere in between. So that is in terms of what all these numbers mean. I'm going to recap at a high level that all of these numbers to the left, to the right, the left calls are always on the left side and puts are always on the right. If you go to any trading platform, it's set up this way, and it's always in a descending order, the strike prices. These numbers are based off of the strike price, how far it is from the at the money, and the date. Okay, so I'm gonna do a further out date. Let me try 2 months out. Okay, we're gonna go back to at the money, and you'll notice that these prices are much bigger, just because it has more time value still stuck in it, because we're further away from October versus Monday, August 4th. All right, so that was a mouthful, and I just wanted to show you. I know that there are some confusing parts to options, but options are insurance for stocks. Insurance have a special element called the time value. How much time is eroding until the end of the contract? Is it worth it? Is it worth to get it that far away? Is it worth, you wanted something closer? Do you want a riskier at the money? You want to buy a day out policy, a year out policy, a 6-month policy? These are the factors that you'll have to consider when you start trading options. We operate on the selling side to get premiums. Some people operate on the buying side, and you're going to have to ask yourself, what is important? What do you want to achieve as a goal? That is today's longer tutorial. Have a good day.